What's going on, guys? Today we're back in the city of San Francisco. Here with Mike with Rice Homes, and we're literally located right now 3 blocks from the Pacific Ocean. We're checking out a listing. Yesterday, Mike showed us a house that they have coming up in the suburbs of San Francisco for $2 million. And today we're here checking out a listing that's coming soon. Mike, can you tell us a little bit about it?
Yeah, hey guys, so we're looking at 2170 46th Avenue in the outer Parkside neighborhood of the Sunset District in San Francisco. Like Steve mentioned, just a few blocks away from the beach, shopping, restaurants, and grocery stores. Very convenient location. This is a 3-bedroom, 2-bathroom, 1270 square foot home. Let's go check it out.
We have a escrow right now that you and I are working on.
Yep.
And it's a client that was previously pre-approved with one of the big lenders, and you hit a roadblock with that transaction.
Yeah.
Can you kind of discuss a little bit about it?
Yeah, so we were actually different part of the Bay Area, Oakland area, about from here where we are in the Sunset District.
Not
Maybe
too far.
35, 40 minutes, no traffic, yeah. They came to me, young couple, first-time home buyers, looking in the Oakland area, and they really wanted a single-family home. That's kind of what everyone's goal is for a home. And when we started talking, they told me that they would like to keep their monthly payment at a certain level, and usually that's what it is for most buyers. Is they're focused on the monthly payment, making sure that it's comfortable. And the roadblock that we hit was they had the down payment, they had the income, but the monthly payment, although they qualified for it, wasn't too comfortable for their budget. It was just going to stretch them super thin. And so the commercial bank that they were pre-approved through was a bit more rigid than you would be. And one of the reasons I like working with you is because you have a lot of flexibility. And so,
But in this case, it was also like kind of like a program that's has some negative component, because people, when they hear the word FHA, they kind of think like, hey, it's for low income, it's for bad credit scores. But my first property, also in Oakland, that I bought 5 years ago, it was an FHA loan, and I have a 760 credit score.
Yeah. Well, I think it's important to note that these FHA programs. So let's clarify. They didn't have a 20% down payment. They had sub 20%, and oftentimes people wait to buy a home until they have 20% down, and they avoid anything sub 20% because they don't want to pay mortgage insurance. It's a tax on. But what's cool about the FHA program, at least the last 2 years, you and I have probably done a handful of them at least, is that the rate tends to be lower than whatever the conventional loan rate is.
Significantly.
Yeah, and so that monthly payment essentially starts becoming attainable, and that's what happened with this particular buyer. Is the difference, I believe, was between 6% to 5.25%, so 0.75% difference
on a big loan. That's a big deal.
Purchase price of 1.2 million, and the other challenge with this buyer was that they didn't want to liquidate more than $75,000 in their savings and assets that they had. They wanted to stick to $75,000 cash to close. That includes down payment, closing costs, everything. And so that was really challenging with the commercial bank. But when I came to you, we sat down, spent maybe, 20, 30 minutes strategizing, came up with a really cool idea. And in a way, I guess stars aligned for us. We've submitted an offer on this property. It was on the market for the second time. It was on the market already 44 days. And
different agent, or
no, same agent. Just funky time in the market. There's these windows sometimes. And what was cool is we also did that buy down. So maybe, you could touch on that.
This was a situation where a client had basically kind of like two pains. One is they were limited on the amount of cash that they have into the deal, including down payment, closing costs, and then also the monthly payment. So we had two challenges that we had to overcome. The down payment, yes, because if you're just comparing, like in the Bay Area, for example, we have big loan amounts. If you're comparing conventional versus FHA, FHA allows you to do a little bit less down payment for the same purchase price. So that's one benefit. And then also, like Mike mentioned, the interest rate significantly lower. It's been a big push from government to try to stimulate home buying. And FHA is considered like a government organization, so that's why their interest rate is significantly lower.
Yeah.
And on top of that, you were able to negotiate with this seller and the agent to give us 9K credit that we used to make the payment the first year not 525 rate, but 425, which added another $700 savings.
Yep.
So I mean, at the end of the day, I think the challenge was to get the deal through. You were able to do it. And then obviously everything else just kind of like, went into place, and the buyer is super happy.
Yeah. I mean, definitely the timing was there as far as the market goes and where we were looking, but this loan really enabled it, because otherwise I think it would have probably been a pause for at least another 12 months until they would have some more money to save up so that they could increase their down payment and get a lower interest rate. And, we've talked about this before. You marry the house, you date the rate. And you can never rebuy the house for a lower price, but you can always refinance into a lower rate. And I want to touch on FHA loans a little bit more, because one of the common misconceptions is it's only for first-time home buyers. Is that true?
No, you could reuse it. The only kind of thing you cannot do is have two FHA loans.
Right.
So it's pretty much impossible.
For your primary residence, basically.
Yeah.
So you can't do it for investment purposes, but you don't have to be a first-time home
No.
buyer to use it, right?
No,
A
no,
lot of
no.
people think that you do. So you can get in as low as 3.5%.
3.5%.
Yeah. So if maybe you have the income and you can afford the monthly payment, but maybe down payment is a little tough, but you have something, you can get in. So 3.5% on $1 million, in this market, that's kind of the starting point. Yeah.
And you get a percent lower on the interest rate. And then if you add some kind of creative approach like buy down, like, man, I think we've done deals like this where people the first year they're paying like 3.5, 4.5%, which is like unheard of for the last 3 years.
Yep. And this is different. There, people are always kind of concerned about adjustable rates, but this is different than ARM loans, adjustable rate mortgages, which balloon after a certain period of time, and it's controlled by the bank, and there's a cap on how much the rate can change. So there's these 5, 7, 10-year ARMs that in 5 years, 7 years, 10 years from now, it starts getting variable. This is a very different approach. It's a 30-year fix. It's just exactly the first year or 2 years or 3 years, whatever buy down we do.
You basically know the worst case scenario up front.
Exactly. And the other cool thing I like about these buy down programs, if you could touch on, is this is different than buying points to bring the rate down, right? Because the money that is let's explain to our viewers exactly how it works. We would submit an offer. We have to ask the seller for a credit, right? So maybe the strategy would be you increase your offer price to offset that difference for the seller so that they're putting in their pocket the same amount, but you're doing a temporary rate buy down. So let's use a two-year buy down, for example. What happens if 8 months from the day that you get the keys, you refinance that loan? What happens with that buy down money?
So it's a big, good question. It's a big misconception, but you definitely don't lose the money. So in short, I mean, we do a lot of these programs, but in short, the way I explain it is like, so you have a rate, let's say it's 525, and you have a dollar amount. It's all calculated. It's all known up front that the seller basically gives you at close of escrow, and this amount is staying with the bank. So it's held in an escrow account with the bank. And this money is used to subsidize your monthly payment every month. So it makes your payment lower, and then a portion of it goes every month from that account to your monthly payment. And let's say the amount for 2 years is $20,000 to do a buy down. And then say in the year you use $8,000 of it. So you have 12,000, then you go ahead and refinance. This 12,000 you don't lose.
Right.
It actually goes into your principal at the end.
Right.
So in a sense, it's kind of like a win-win. So you have a lower payment up front.
Yeah.
And then this amount that the seller gave you to help out with the payments for the first year, 2, 3 years.
Yeah.
When you refinance, you don't lose it. It actually goes into the principal.
Right.
which is huge. It's not one of those things that the bank makes money and then they hold this, and if you refinance, you lose it, like
Yeah.
points do.
Yep.
Because if you're looking at a permanent buy down and say you give up $20,000 and you buy the rate down like 1%, but in 2 years, if the rates are down 2% and everyone is refinancing, you're gonna want to refinance too.
Yep. But
And
you're
then,
gonna lose that money.
exactly. So you gotta always kind of calculate it. So it's an awesome program. Like, you know, we're doing it a lot with you. I've probably done maybe like almost half of them with your team as well.
Yeah.
You guys know how to pitch them to the selling side.
Yeah. Well, and again, you can offset the purchase price. You can increase it so the seller nets the same. And somebody would say, well, why would I pay more for the house? Because realistically, in a couple of years, even if you increase your purchase price, let's say 10K to get that buy down,
Yeah,
it's going to appreciate way more than that in the next couple of
for
years.
sure.
So you get into that house, you know, it's yours. You're paying into something that you own, and that money isn't going into the abyss like it would with a
Dude,
rental.
I've even with a different client, but I've even went as far as to calculate it. Like, hey, what if we increase the price by 30K?
Yeah,
And I show them how much difference, because obviously your property taxes are based on the price, right?
absolutely.
So if you're increasing it, you're basically paying a little bit more
Yeah,
to get this program. And then we ran it very detailed to show a client like what's the difference in property taxes in say 10 years,
yeah.
like if you increase the price. And the amount is so minimal, like, you know, clients say, you know what,
Let me ask you this. Do you need to get pre-approved to run any of these numbers?
Uh, not,
Let's say somebody knows that they have good credit or whatever,
yeah.
you know, ballpark. Do they need to get pre-approved to run these numbers with you?
Numbers, no numbers. I mean,
So,
there's no calculator on like Zillow for it, but like
sure.
to kind of give people an idea, like, hey, this is the loan right now. If we ask X amount from the
Yeah.
seller, this is what your payment's gonna be. So that's easy. It's all a
And
couple
this
buttons.
isn't, I know that you don't only service California, you service many states in the United States. This can be done in many other states,
Yeah,
correct?
it
Yep.
works for conventional. It even works for jumbo loans.
Yep.
So it works all over. But the FHA one stands out because you could do less down payment and you're already getting a lower rate. And then if you add this on there, you're getting a rate that's like unheard of. People that were buying during COVID got rates like that, and you have an opportunity to get it today.
Yeah. So to all of you watching this video, if you're interested in just running some numbers, you don't have to run your credit. It's just a quick conversation. We'll leave a link down below in the description where you could book a time with Steve and maybe run some numbers and just get an idea because I'm a firm believer, you know, when I meet a lot of my clients, doesn't matter if it's a buyer or seller in strategy, sitting down, getting a whole picture and
Mm-hmm.
understanding what's going on, what are we doing, what's the plan afterwards if you're selling, where are you moving to, or if you're buying, you know, making sure that you understand it's not only the monthly payment, but factoring in, you know,
Mm-hmm.
increase in costs and so on. It's all about strategy. So, uh, unfortunately, I think there's a misconception out there that just because you get on the phone with a lender like yourself, that
Yeah.
automatically you have to run the credit. But you're always happy to just run numbers with my clients, you know, no strings attached. And so if that's interesting to you, just definitely click on the link down below and schedule a time with Steve and run some numbers with him, just to educate yourself and at least to have a plan.
Thanks, man. It's been an awesome 2 days. Thanks
Yeah.
for showing us two of your listings,
Yeah,
and
absolutely.
looking forward to seeing more. And good luck on this one.
Absolutely. Yeah. Thanks, guys. Please look out for us. We're Rise Homes in the San Francisco Bay Area. You could visit our website at homesbyrise.com. My name is Mike Sinitsky, San Francisco Bay Area native and realtor, here with my buddy Steve Tvetkov with AUE Lending.
Thanks, guys. See you soon.